Companies create three types of financial statements to show its performance: the balance sheet, income statement, and cash flow statement. We have already learned about the balance sheet and income statement in our previous videos, and in this video, we will learn about the cash flow statement. We will understand what a cash flow statement is, why it is prepared, and what information it contains. Hello friends, welcome to our YouTube channel, True Investing. For stock market ebooks, courses, and free live classes, download our app, True Investing Academy. Now let's learn about cash flow statements. A cash flow statement is a financial statement that tells how much cash came in and how much cash went out of a company during a specific period. It also shows the change in the company's total cash during that period. Generally, we analyze the cash flow statement in the annual report, where the time period is 1 year. Before we move forward, it is essential for us to ask why companies need a separate cash flow statement when the company already reports its net profit in the income statement. The answer to this question is that the income statement is based on accrual accounting. In accrual accounting, companies record their revenues and expenses when transactions occur, regardless of whether cash has been exchanged or not. For example, when a company makes a credit sale and gives the customer 60 days to make the payment, the company counts its credit sales and associated profit at the time of the credit sale, even if the company receives the cash payment from the customer after 60 days. Therefore, there is often a difference between the net profit reported and the actual cash received by the company. Cash is called the lifeblood of companies because many payments, such as salary payment, interest payment, and day-to-day expenses, need to be made in cash only. And if a company cannot convert its profit into real cash, it can be very dangerous for the company. Understanding this importance of cash, investors analyze the company's cash flow statement carefully and try to understand where the company's cash is coming from and where it is going. The cash flow statement divides a company's cash flow into three parts: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. For each of the three parts, the net cash flow is calculated by subtracting cash outflow from cash inflow, and then the total change in cash for the company is determined by adding the net cash flow from all the three types of activities. For example, let's consider AB Limited, a company whose cash flow statement is as follows. The cash flow statement is also known as the statement of cash flows. Here, AB Limited cash flow statement is divided into three parts, and we will understand each part one by one. The first part is cash flow from operating activities. Operating activities refer to the activities directly related to the company's main business. It includes cash flows from sales, purchases, and general expenses. The net cash flow from operating activities is calculated by subtracting the total cash outflow from the total cash inflow. In the case of AB Limited, the net cash flow from operating activities is 200 crore rupees. Cash flow from operating activities can be calculated in two ways: direct and indirect. Here, the direct method has been used, and we will understand the indirect method in some other videos. The second part is cash flow from investing activities. This part involves cash flows related to the buying and selling of long-term assets such as property, plants, and equipment, as well as various types of investments, which mainly include mutual fund investments, shares of other companies, and interest income. The net cash flow from investing activities is calculated by subtracting the total cash outflow from the total cash inflow. In the case of AB Limited, the net cash flow from investing activities is minus 125 crore rupees. The third and final part is cash flow from financing activities. This part includes cash flows that result in changes to the company's debt and equity capital. Examples include borrowing or repaying debt, making dividend payments, issuing new shares, or buying back shares. The net cash flow from financing activities is calculated by subtracting the total cash outflow from the total cash inflow. In the case of AB Limited, the net cash flow from financing activities is minus 500 crore rupees. Afterward, the net cash flow from all three parts is added, which gives the net increase or net decrease in the company's cash balance over the year. Then, we add the net increase or decrease in cash to the company's cash balance at the beginning of the year, which gives the ending cash balance for the year. In the case of AB Limited, when we add the operating, investing, and financing cash flows, we find a decrease of 425 crore rupees in the total cash of the company over the year. In other words, AB Limited experienced a decrease of 425 crore rupees in its cash balance during the year. Now, AB Limited's cash balance at the beginning of the year is 2,500 crore rupees. From this, we will subtract the cash decrease of 425 crore rupees. This will give AB Limited's cash balance at the end of the year as 2075 crore rupees. It often happens that good companies are sometimes unable to manage their cash flows properly, which leads to financial difficulties even after making consistent profits. That's why investors pay a lot of attention not only to a company's profits, but also to its cash flows. The most important part of the cash flow statement is the cash flow from operating activities. If a company's cash flow from operating activities is negative, it indicates a significant problem in its business. Negative operating cash flow means that the company is unable to cover its expenses from its main business. In such cases, the company has to bring in cash from its investing and financing activities to pay for its expenses. On the other hand, if a company's cash flow from operating activities is positive and continuously increasing, it is considered very good for the company. Investors often compare cash flow from operating activities to the company's net income. If a company's cash flow from operating activities is higher than its net income, it is considered to have high-quality earnings. It is said that analyzing companies in the stock market requires both skill and art. Before investing in any company, we should analyze all the three financial statements: the balance sheet, income statement, and cash flow statement. But along with that, we should also consider the industry the company is in, the products or services it sells, and the potential future demand for the company's products or services. We only make good profits in the stock market when the company we invested in makes consistent profits. That's why we should carefully think and analyze companies before investing our hard-earned money. So this was our video on the cash flow statement, in which we learned what a cash flow statement is, why it is prepared, and what kind of information it contains. If you found this video useful, hit the like button. And if you want to learn more about stock market, investing, and finance in simple words, do subscribe to our channel and press the bell icon. Also, if you have any questions related to this video, you can ask in the comment box. Thank you, friends. See you in the next video. Take care.